It's Friday, 20th of March, and this is your Capital Economics Weekly Briefing. I'm David Wilder, and we are nearing the end of the third week of this conflict. Brent crude is about $110 a barrel as we're speaking. That's 10:30 a.m. London time, 6:30 in the morning in DC, 2 o'clock in the afternoon in Tehran. Oil was even higher on Thursday, but then Benjamin Netanyahu said he saw this war ending a lot faster than people think. That said, not much sign of a let-up as we're speaking now on Friday. We are not going to speculate on when the fighting will end, but we are going to talk about the growth and inflation implications of what we know so far, and about how central bankers are going to respond to them. To find out, I'm joined by Group Chief Economist Neil Shearing and by Chief Global Economist Jennifer McKeown. Hi both.
Hi David.
Hello.
Neil, set the scene for us. As I say, we're about to enter the fourth week of fighting. Not much sign, as I say, of a let-up. How have perceptions in the market shifted as this war has developed?
Well, I think there's been two big developments over the past week. The first was the news that we had yesterday. So we're speaking on Friday. So on Thursday, we had news out of Qatar that the damage that was sustained to the Qatari gas field by that Iranian strike at the time was described as extensive. We've got a clearer sense of the extent of the damage now, knocking out the Qataris say 17% of gas production for the next 3 to 5 years. So a significant escalation in the conflict from the perspective of the global economy this week, because gas production facilities in Qatar have been hit and oil production facilities in Iran have been hit. So first big development is major escalation in the conflict this week insofar as it relates to the global economy, because it's because of the hit to gas and oil production facilities. Second big development following on from that is the response in markets. We've had a swathe of central bank meetings that we'll get into this week, but the broad response to that in bond markets has been to price in a more aggressive path of monetary policy tightening. So we've seen big sell-off in bond markets. We're talking on Friday morning, bond markets in Europe had a slight state of meltdown, actually. If you particularly in the gilt market, big moves across the curve in the gilt market today. That's markets pricing in a more aggressive response from central banks in anticipation of higher inflation because of the disruption to energy supplies.
Yeah, so the initial considerations around how this was going to develop, we had what we were calling a relatively benign scenario where you get a relatively short, sharp conflict. But the idea that was relatively benign was contingent on the idea that there wasn't this lasting damage to infrastructure. But what you're saying is that really is the key change in terms of...
I think it was contingent on two things, really. One was that traffic through the Strait of Hormuz would not be substantially disrupted, or at least not substantially disrupted for a long period of time. Clearly, we're into, as you say, the third week now of this conflict, and we've had 3 weeks really of extensive disruption to shipments through the Strait of Hormuz, ground to shipments other than those from Iran grinding to a halt. So first thing that prevents us from being in a benign scenario is extensive disruption to energy supplies and energy shipments. And then the second point, as you say, is the fact that over the past week, we've seen production facilities being hit as part of both US-Israeli strikes, but also Iranian retaliation.
So we're now in a less benign scenario.
We're in an altogether more challenging scenario, I think it's fair to say, yes.
Okay, so translate that into sort of the economics, as you say. I mean, this is all about how this is being perceived in the market in terms of the impact on economies. What are we seeing coming through? What should we be looking at in terms of the negative impact from all of this?
At the risk of stating the obvious, the bigger the energy shock, the greater the economic shock. I still think it's not quite as large as was the case in 2022 at this juncture. But clearly the macro impact of all of this is going to be greater than we had assumed in our baseline scenario, a few days into the conflict. For what it's worth, we're working on the basis, and we're going to recut all these forecasts and publish them over the coming days, but we're working on the basis that in a baseline scenario in which the conflict does start to fade through the course of April, the strait is reopened by the end of April. Even then, we'd have Brent crude at about $80 a barrel by the end of this year. We'd have gas prices at 60, 70 euros by the end of this this year too. So that would still represent a substantial terms of trade shock, particularly to the economies of Asia and to and Europe, and that would feed through into to particularly to inflation. So we'd have potentially you get inflation in the Eurozone and in the UK up at the kind of 5-6% rates for a period of time.
Is this, when you talk about energy shocks, I mean, what about in terms of just broader supply chains, access to these critical inputs that really power the global economy? Are we seeing much disruption there? Is that another reason to be concerned about the outlook?
That's a really, really important point to make. We naturally focus in all of our analysis and our conversations about what's happening to natural gas prices, what's happening to the Brent crude price. In reality, the way this is feeding through first and foremost in economies is in the refined product market. So the way this is affecting conditions on the ground is particularly through gas prices, petrol prices increasing, and we've seen some particularly substantial increases in those petrol prices in Asian economies over the past week. So that's where it's hitting first. But you're right that the longer the conflict persists, and in particular the longer the duration that the strait is closed, then the wider the disruption is going to become in other products and key inputs. So we talked on the podcast last week about the fact that 40% of the world's helium comes from Qatar. This is a byproduct of the production of natural gas. 40% of it's coming from Qatar. It's an input into things like semiconductors. We talked too about fertilizer. We learned over the past few days that Japan has started to warn about lack of supply of naphtha, which is a critical input into the production of plastics, which are used in everything from production of cars to circuit boards and electronics. So the point being that the longer the conflict persists, the more likely it is that we start to see some of these, the shortages of some of these critical inputs become an issue. And therefore, in a macro sense, what that means is that the economic damage becomes what economists call non-linear. It's not just the case that the economic damage kind of increases in a linear sense with the duration of the conflict. It actually intensifies it. It actually increases exponentially as the conflict persists.
It certainly feels like this is another of those global crises that we've had in recent years. This is the latest one. I wouldn't want to be a central banker in this climate, I've got to admit. But Jenny, it has been an unusually busy week of central bank meetings. Going into this meeting, I just want to talk about what was decided over the past week, because going into these meetings, you spoke about a classic policy dilemma that central bankers face. Talk a bit about that dilemma and talk a bit about what we've learned over the past week in terms of the decision making, in terms of the tone of the communications.
Yeah, okay. Well, it certainly is a challenging time for central banks. The Middle East conflict is an external supply shock, which is raising energy prices and will push inflation up. But at the same time, that squeezes real incomes and confidence, which drags growth down. So that's the dilemma, and that's what leaves central banks in a really difficult position. If they raise interest rates, they can contain inflation, but they risk deepening the slowdown. If they cut rates, they can support growth, but they risk letting inflation become more persistent. So there's really no clean policy choice. There are only trade-offs here. And importantly, the right choice depends on the economic backdrop. If it's strong, and inflation expectations or wage growth are high, then there's a much bigger risk of those second round effects causing a persistent rise in inflation, and central banks should tighten policy in that scenario. But if the backdrop is very weak, then it's perhaps the growth risks that dominate. There's a possible case for loosening policy in response to that drag on real incomes and on confidence, or at least in keeping rates on hold to wait and see whether there are any more persistent inflationary effects that are materialising.
Okay, so that's the broad framework. And as you said, I mean, the temptation to look at the decisions that came out this week, and there are a notable one or two, but to lump them all in under the category of waiting to see, ready to act, watching what's going on. But as you suggest, there's a nuance in their approach, and that depends on the macroeconomic backdrop. Let's talk about the banks that are maybe on the more hawkish side of the spectrum, because it speaks to what you're saying there about the macroeconomic backdrop. Specifically, I'm thinking about the RBA, the Reserve Bank of Australia, and the Bank of Japan. What do we learn from those meetings?
Well, it's been a really interesting week. It's hugely challenging for central banks, of course, but really interesting for economists to see how they're managing this. And we've seen just a really clear illustration of how a different backdrop can affect central banks' communications and the way that they view this trade-off between growth and inflation. So you mentioned the RBA. I mean, that's probably the clearest example. Well, it's the only bank that's hiked interest rates this week, and it's the clearest example of where the possibility of second round effects is a real concern. In Australia, headline inflation was already close to 4% at the start of this year. There were concerns about it being above target, about it potentially rising further above target, with the unemployment rate still low and employment growing strongly, so that the labour market's tight, and that's adding to inflation concerns. So in that environment, yes, it makes sense to be tightening policy and to be warning of the potential persistent inflationary impacts of this shock. For the Bank of Japan, slightly different situation where policy was already set to be tightened. The Bank of Japan faces relatively strong wage growth too. We've seen that in the early stages of wage negotiations this year. And additionally, for the Bank of Japan, the starting point for interest rates is really low, just 0.75%. So there's perhaps a stronger case there to be raising interest rates further in response to this shock.
All right, and then moving along the spectrum, because these are really interesting, aren't they? Where you had banks where either they were on the sidelines or the expectation was that they were going to cut rates this year. They've now swung very much to the other side of that debate, from the sort of the dovish side to the hawkish side, because of the outbreak of the war, because of what's happened with energy prices. So Christine Lagarde, head of the Governing Council at the ECB, saying yesterday that they're going to be more attentive to risks than they were in 2022. What do we make of that, Jenny?
The ECB has historically been a relatively hawkish central bank, very cautious about not allowing inflation to get out of control. That comes from kind of a Bundesbank tradition. But in 2022, it did let things slip. There was a general sentiment among advanced economy central banks that inflation pressures would be transient. It turned out that wasn't the case, and there was an increase in wage growth, even in the Eurozone, where wage growth had historically been really persistently low. So, of course, the ECB is now alert to this risk. It's coming from a starting point where the economy is not particularly strong, where inflation expectations are relatively well contained, inflation itself roughly at target. So it's not clear that it does need to be the most concerned of the central banks. However, it's understandable that it's flagging these risks, particularly given that it looks likely that the impact on inflation from this shock is going to be particularly large in Europe, given the effects that we're seeing on gas prices.
Is there a danger, excuse the pun, is there a danger that they're fighting the last war, in as much as they'll respond to the energy shock, they'll raise interest rates, but actually it's a too heavy-handed, trigger-happy approach to policy that winds up weighing on activity in Europe?
Yes, there is a danger of that. And I think there's a significant possibility that perhaps even as soon as April, the ECB hikes interest rates. Then it becomes clear that this is a temporary shock and that actually the economy is still really quite soft, and that ends up being kind of a one-off, and perhaps they even ultimately need to revert to loosening. But I think probably if there's one central bank that is likely to err on the side of caution in this regard, then it probably is the ECB.
Neil, what about the Bank of England? I mean, you're talking about what's been happening in the bond market. Gilt's getting hit particularly hard. Are they in the same boat as the ECB, do you think?
Well, they're in a similar boat, but there's some important differences. What's the similarity? Well, as Jenny just said, the UK is facing an inflation shock of a similar order of magnitude to that of the Eurozone, both, of course, large net energy importers. However, one of the differences, well, the UK is a bit more of an inflationary economy, I would say. We've learned a bit about that over the past few years. There's quite a high degree of indexation in the UK economy. Inflation's running at a structurally higher rate anyway. There's also an interaction here with fiscal policy. Political developments over the past week or so have not been particularly favourable for the gilt market, with Angela Rayner on manoeuvres against Keir Starmer, and that feeding through into concerns about the fiscal trajectory in the UK over and above anything that we might get in terms of fiscal support for in the face of this energy shock. So the important differences with the Eurozone are inflation expectations are a bit higher, the economy is a bit more inflationary, and the political backdrop is different and perhaps a bit more adverse for the gilt market. All of that, I think, helps to explain why we've seen a bigger reaction in the gilt market over the past 48 hours.
And I think also from the Bank of England's perspective, Andrew Bailey gave a really clear illustration of the dilemma that central banks are facing at the moment after the meeting. That the statement from the Bank of England said that it was ready to act, and it's pretty clear there that it's trying to control inflation expectations. It's trying to prevent these second round effects by saying, OK, we're ready to act. Markets then respond to that. You see this significant increase in interest rate expectations, which means that financial conditions are tightening already before the Bank of England has even raised interest rates and before it's ready to do so. So in response to that, Andrew Bailey then has to come out just over an hour after the meeting and talk markets back down, saying markets are getting ahead of themselves in assuming rate rises. I'd caution against reaching strong conclusions about us raising interest rates. So I think this just really highlights that there's a huge dilemma and a balancing act for central banks, and it's incredibly difficult to get that right.
And of course, that interjection from Bailey had next to no impact on the gilt market. So that's another kind of revealed truth in all of this, is once you have to send your central bank governor out again for a second go round at communications, you're already on the back foot and it's much more difficult to shift the market. So central banks are in a really difficult spot here.
I think it really does, doesn't it? It just highlights just how sensitive this moment is in terms of, as Jenny talked about, that balancing act, the sort of the stagflationary challenge. Do you emphasize the stag or the flationary is how our UK team has tried to frame this. Just for completion's sake, though, it is worth noting we did have some dovish moves this week, some dovish communications. That we had a rate cut from Brazil's central bank, certainly worth mentioning there. Our LATAM team talking about the restrictiveness of Brazilian monetary policy going into this crisis. So we did get a 25 basis point move, not the 50 basis point move that had been speculated. Still, Brazil's now in this position of uncertainty, not sure what's going to happen next, very much dependent on how the war develops, where energy prices go.
But new finance minister in Brazil as well, just to add into the mix as well. So some uncertainty over fiscal policy.
Yeah, absolutely.
Too. But again, that illustrates the point that Jenny was making in the differences, I think, potentially with 2022, that the starting point in Brazil, I think it's a really interesting point. The real interest rates in Brazil were very high coming into this crisis. In the opposite way, that real interest rates in 2022 in the developed world were very low. So Brazil's central bank can now cut. Now central banks in the developed world are thinking about hiking rates. But even if we do get some rate hikes in our baseline scenario, do you think they're going to be as aggressive as 2022, because we're starting from a very different place?
Yeah, and I was going to mention the Bank of Canada as well, because again, they're slightly dovish communications, says our Canada team, because of where inflation was in Canada going into this crisis.
Yes, that's right. So I think the Bank of Canada is one of those examples where the economic backdrop is weak, and therefore the central bank can afford to look through the supply shock, or potentially even be more concerned about its possible downwards impact on growth. CPI inflation's low in Canada, about 1%. Last month, trade and manufacturing sales data point to GDP falling at the start of this year, and also unemployment is rising. So it's clear that the Bank of Canada faces a very different economic backdrop to the RBA, for example, and the risk of second round effects is relatively low. So the bank can keep its eye on supporting activity for now.
Neil, what about the Fed? We haven't mentioned them. A statement came on Wednesday. Where market pricing is now in terms of expectations for Fed moves this year, does that look broadly right to us?
So you're right, the Fed, the world's most important central bank, and we had that press conference afterwards where Fed Chair Powell refused to say whether he would actually step down from the Fed board as a Fed governor, where his time as FOMC chair comes to an end in May. If that were to happen, it'd be the first time since the 1940s when a Fed chair has stayed on. So in any other week, this would have dominated the headlines, and it's barely got a look in. So it gives you a sense of where we are. Now, in terms of the messaging from the Fed, it's fair to say, I think, much more balanced than was the case with the ECB, the Bank of England, which emphasised, as we've just been discussing, upside risk to inflation. Fed a bit more balanced, reflecting that there's been a repricing in markets. So the market's now priced out rate cuts in the Fed, but the market's not yet pricing in rate hikes either. Does that look reasonable? I think so on balance, yes. If you think about the kind of hierarchy of central banks from hiking to holding through this crisis, the ones that were already in tightening mode will just use this as reason to continue tightening. That's the BOJ, the RBA. Then the next tranche are the banks that are worried about inflation expectations and price setting behaviour becoming unanchored. That's the ECB, the Bank of England. And then you get central banks like the Fed that's got dual mandate anyway, so it needs to think about the employment side of its mandate, as well as it's not just inflation. They were in a loosening cycle before this crisis hit. The crisis itself is not going to affect the economy in the same way, insofar as the US is a small net energy exporter, so perhaps a bit less vulnerable on the economic side to this crisis. Does that mean the Fed stands pat when other central banks could hike? Yes, I think so. It's still possible that we might get a rate cut later this year if the conflict ultimately fades over the next few weeks. So I think broadly speaking, it looks reasonable to me, yes.
I want to come back. I started at the beginning talking about Benjamin Netanyahu's press conference yesterday's comments about the war ending a lot faster than people think. Clearly acutely sensitive in the White House about the economic damage being caused by the war and trying to manage the message. Now we have the Israeli Prime Minister seemingly trying to do the same. If this fighting ended today, how much can we go back to where we were? The world of end of February, that's gone. But how far back would conditions just snap back, or are we in a very different paradigm?
And I'm always a bit wary when someone says this is a paradigm shift, but I do think that we've learned something over the past 3 or 4 years about the global economy, which is that supply side shocks are becoming more frequent. COVID, the most obvious example of that. But then we had Russia's invasion of Ukraine, the energy shock that followed that. We've had tariffs and the impact on trade. Actually, the trading system remarkably resilient and adaptable in the face of that. Now we have this energy crisis following the war in the Middle East. So we're learning that the supply side of the global economy that we've basically taken for granted for the last 30 years is actually more fragile, and there are key choke points in the global economy that are now being exploited for political and geopolitical reasons. But insofar as it relates to this crisis in particular, even if there were to be a resolution, I don't think we'd necessarily see a quick normalization in energy markets, which is clearly the way that this is impacting the global economy. There would still be a risk premium embedded in both oil and particularly natural gas markets, not least because we've just learned that 17% of Qatari production is going to be offline for the next 3 or 4 years. So I don't think we snap back into a world at the end of February when this conflict erupted. And I think we are heading into a world where supply side disruptions have become more frequent and will continue to hang over the global economy.
Jenny, similar question. If the war did end, I mean, given all that Neil's just said, how much are the rate cut expectations have been purged from markets so brutally over the last few weeks? How much do those rate cuts come back onto the table if we do get an end of conflict?
I'm afraid an annoying economist answer to that question is that it really depends on what else is happening at the same time and what the economic backdrop is. I think it's very likely for a start that we see some risk premium remain in energy prices. So I don't think it will be the case that if the war does end quite quickly, that we see a snapback in the path of oil prices to where we would have anticipated before it started, and likewise for gas. So for that reason, the inflation backdrop for headline inflation at least will be a little bit higher. So perhaps there's less chance of rate cuts, at least to the extent that we had previously anticipated. That said, I think there will be scope for some policy loosening if this really is a temporary shock, because in the Eurozone and the UK, for example, we know that labour markets have been loosening, and that should have pointed to weaker inflationary pressures. So assuming that the upward pressure on inflation is temporary, then once that has passed through, you should see renewed downward pressure on core inflation, which might allow some central banks to reduce interest rates, particularly those that are starting from a relatively high level, like the Bank of England.
Jennifer McKeown and Neil Shearing there on the global economy and the impact of the conflict in the Middle East. As Neil said, the team's finalising new macro and market forecasts off of a baseline scenario of how this situation develops, which we will be publishing to all clients in the coming week. Then on Thursday 26th, we will be holding drop-ins, which are our short-form online briefings, so that you can ask Jenny, Neil, and the rest of the team about those forecasts. There'll be 2 sessions that day to cover most time zones, and I will link to them in the podcast notes. As Neil and Jenny suggested, this is a regional war with global economic and market implications. It's times like this, and they seem to be happening with greater frequency, that it's critical that you get a full picture of what's happening, where and why, and that you're correctly positioned for what comes next. Capital Economics has all access subscription options that give you the full picture with comprehensive analysis, plus an extensive suite of data tools and options for direct engagement with our Economist team. Drop us a line at podcast@capitaleconomics.com today, and we can set you up with trial access. But that's it for this week. We will be back next week with more around this age of upheaval and what it means for global macro and markets. Until then, goodbye.